Welcome back. Investors at the equities market remained downbeat on Tuesday, with the all-share index dipping further by 2.41%, highest loss in 5 months, to 41,708.15 points, following profit-taking across all the major sectors. The consumer goods sector led the pack, followed by the industrial goods, insurance, oil and gas, and banking indices. The losses were driven by profit-taking in the shares of Dangote Flour, Dangote Cement, Equity Assurance, Forte Oil, and Skybank. Market breadth remained negative, with 40 losers and 15 gainers. Total volume traded declined by 9.07% to 470.52 million units, valued at 3.68 billion naira, and exchanged in 6,309 deals. Well, there is no doubt the Nigerian equities market has been on a bearish mood since the last 7 trading sessions in February, with the market losing 6.6% cumulatively. It is perhaps safe to say that while January was a bull market, with the NSE All-Share Index gaining 16%, February, on the contrary, has seen the bears take center stage. Now, what factors have been responsible for these, and what are investors expected to do given this circumstance? Joining me at this time to shed more light into this is the head investment research at AfriInvest Securities Limited, Robert Omotunde. Good morning, Robert. Thank you very much for joining us.
Thank you for having me.
Right, we've seen the Nigerian equities market decline for the 7th consecutive session, as a loss of 6.6%. Now, should investors start getting worried at this point, even though this is coming at a time where we're seeing some kind of decline in the global oil market? Well, sorry, global equity markets.
Well, naturally, you expect investors to be worried, because we're talking about money here. The 6.6%, if you apply that on the current market cap, it tells you how much investors have lost. So naturally, investors will be worried. But the fact is, we have to look at what has panned out within a couple of days, since we've seen the market shed points consistently. January was a bull market, like you rightly mentioned. We saw that January returned 16%. In fact, at some point in January, the year-to-date return peaked at 17.9. So naturally, you would expect that there should be market correction. But that market correction came at a time when you also have global rout in terms of the performance of global equities market, and this is stemming from the expectation of interest rate hike, in the U.S. Also coupled with the fact that you now have a stronger dollar. Last week we saw that crude oil production has, increased in the U.S. market, and this is informing the outlook on oil prices. Shale producers, they've hit the market again. They're expanding their operations, and all of this is very positive for the U.S. market, which is by far, one of the largest consumers, of energy when it comes to crude. So this also came at that time, and then it appears that the Nigerian market is following, the global trend. Now, but what we have analyzed is that the market is going through a phase of correction, and that must be clear, because when you saw the market gaining up to 16% in January,
which is quite unusual for January, isn't it?
Well, it's a January effect, coupled with the fact that we had some form of, should I say, some regulations that were put in place last year. We had some reforms in the foreign exchange market. These are some of the things that foreign investors tapped into, and they came into our market. It was quite similar to what we saw in 2013. But what is panning out now is that some investors are retreating. We have spoken with some of our traders, and from what we heard from other houses, foreign investors are still very much comfortable with the direction of the market, because fundamentally nothing is wrong with the market. Except with the fact that we've seen global oil prices trending downward last week, and Nigerian market has always been correlated.
That is also
yes,
impacting on
it's
the
always been
markets.
correlated with the movement in global oil prices. But there's no cause for alarm. We are expecting that markets should begin to turn within the next couple of days, because the level of RSI you're seeing now was last seen. This RSI, that's relative strength index of the market. It's a technical indicator of the market. We last saw this in April 2017. That was before the launch of the I&E FX window. That actually turned sentiment in the market. So for investors, investors just need to, watch which stocks, they need to watch which stocks they are playing in. And of course,
everybody seems to be talking about market
yep.
correction. Globally, they talk about market correction. You're
Right.
here talking about market correction.
Yep.
So how long is this market correction going to take? That's what any average investor would want to know.
Yeah, well, because it's the market. The market is driven by the sentiment of humans, and it's very difficult to predict human behavior. It's one of the things that makes social sciences unique, economics by far. Now, so when the market will turn, nobody may be able to tell for sure. But what we know is that there are indicators that suggest to us that market may be nearing its bottom and is presenting more opportunities for upside. And we think that we are very close. We said it when the market was, up there at 16% in January, 17.9% year to date. We still expect a correction of the market. Our projection for the market in 2018, base case, is 19.8%. So meaning that we're expecting that at some point, market will take a breather and present new opportunities for new investors.